Hello and welcome. My name is Partho Mujumdar. In this video, we will discuss the straddle strategy for options trading. Now, we use the straddle strategy when the markets are volatile. That is, the markets may move in either direction. What we mean is that the markets may either move up or they may move down. This strategy of straddles is used only for trading in stocks as the underlier. So we cannot use it for any other underlier, only we can use it for stocks. This is a very expensive strategy that you will realize as we discuss further. Let us understand the basic concept behind the application of straddle strategy. Now, there are occasions like when we have the elections. This can happen in any country. Now, when the elections are there, the markets wait and take a reaction after the election results are declared. After the results are declared, the markets may move up or they may move down, depending on how the market feels about sentiments. So these are the situations when the investor is unsure whether the market will move up or he will move down. Similarly, when the central banks announce the monetary policy, just before the announcement of the monetary policy, the markets wait for the monetary policy to be announced. Then they either move up or move down based on how they feel about the policy which has been announced. So this is applied only for stock trading. This is not applied for any other underlier, so that is important. So the important thing is that when the markets are volatile, we apply the straddle strategy. In the straddle strategy, what the investor does is that to cover for the market movement in either direction, he buys a call which covers for the direction of movement of the market in the upward direction. Also, he buys a put option. So in case the market moves down, he will use the put option. So he buys a call option and a put option. Since he buys two options, the strategy is a very expensive strategy because two options have to be purchased. Now, what happens is that the call and the put option, what the investor purchases, it is exercised on the same underlier for the same strike price, for the same quantity, and maybe the premiums are different for the buy of the call and buy of the put. So the important thing is that a call is purchased, a call option is purchased, and a put option is purchased on the same underlier for the same quantity at the same strike price and maybe a different premium. So, and this straddle option is exercised on the same expiry date for both the call and the put option. So, on the expiry date, if the market moves up, the call option will produce benefits. If the markets move down, the put option will produce benefits. Now, the benefits, what the call and the put option, either of them will produce, has to be sufficient to cover for the two premiums what will be paid. One premium paid for the call option, one premium paid for the put option. So the benefits will be only available as a profit to the investor if the market moves sufficiently to cover for the two premiums that is paid. We will see this through some illustration and examples. Let me set up an example for discussing the straddle strategy for options trading. Suppose we have an underlier where we buy a call at a strike price of $102 and a premium of $3. Also, we buy a put at the same strike price of $102 and a premium of $1. So here the premium of the buy call and the buy put are different. The buy put having a lesser premium than the buy call. Nevertheless, the strike price is the same. So you see that we have only one strike price. The strike price at which the call option is purchased and the strike price at which this put option is purchased. So this is the premium what we pay for the call option and this is the premium what we pay for the put option. So you see that we are paying two premiums. So the net premium will be the sum of these two premiums. That is, in this case, the net premium will be $3 plus $1. So the net premium will be here, which is $4. So this is the first thing. You see that already we are having an expense which is high because the premiums are getting added because both the options are purchased. Now the options, like we have said, they will be excised on the same expiry date. So now we will study how the market prices at different expiry dates influence how the straddles option will generate payoffs for the investor. So first let us consider the situation when the markets rise. So we know that our strike price in the example is at $102. When the markets rise, the market price will be higher than $102. Now, if we had just purchased the call option, which is the green line here, then we know that we will break even on this call option only when the market rises by the premium which we have paid. That is, if this distance is equal to this distance, the call option will break even. So at this point, the call option will break even. That is, this is $3 and 102 plus $3, that's $105. However, we have also purchased a put option where we have paid this premium. Now, to cover for this premium, the markets have to rise further so that we will break even. Let us understand this by calculating our position at this point where the market price is $106. So let us consider this as the market price and let us see what the calculations work out to be. Now $106 is greater than the strike price of $102, so the call option will be exercised and call option will produce a profit. So the market price is at $106 minus $102, which is the strike price, minus the premium paid, which is $3. So the profit will be of $1. Now, since the markets are at $106, which is greater than $102 strike price, the put option will not be exercised because put option requires the markets to fall. Since the put option will not be exercised, the investor pays the premium for the put option, which is $1, and suffers a loss of $1 per unit. So net position is that he earns $1 from the call option and he loses $1 from the put option. So he has a net position of $0. That is, he breaks even at this point. So you see that the break-even point of the straddle strategy is higher than if we had just purchased the call option. Let us analyze one more position that is at a market price of $110. That is somewhere here. So let us see what happens here. The call option will be utilized. The call option will be exercised at $110 market price minus $102 strike price minus premium paid of $3. So he makes a profit of $5. And the put option will not be utilized simply because the market price is higher than the strike price of the put option. So the premium will be paid, which is $1. And so the net position is that $5 profit minus $1 loss, which is a $4 profit. So you see that the profits are possible in a straddle option. However, the market has to move sufficiently so that it covers with a premium which is paid in total for the two options which is purchased. Now let us analyze the situation when the markets fall. That is, this is a strike price and the market is moving in this direction. So the market price is somewhere in this area. So now first let us take the condition that the market price is falling, and if it is at $101, then this is the point where the put option breaks even because the put option has a premium of $1. This amount, if the market falls by this amount, then the put option will break even. However, since we have also purchased a call option at a premium of $3, so the market has to fall further so that we break even on this straddle strategy. So now you notice that this is the $1 which is the premium for the put option plus the $3 which is the premium for the call option which we have paid. So if the market falls by this amount plus this amount, then we break even. So the break even point when the market falls is the strike price of the put option, or this is the same strike price of the call option and the put option, the strike price minus the net premium paid. So let us see the situation when it is at $98 that to verify whether it works or not. So at $98, what happens is that the market price is below the strike price of the call option, so the call option will not be exercised. So we will have a loss of $3, which is the premium paid for the call option. So this is a loss of $3. However, the put option will be exercised because the market has fallen below the strike price of the put option. The profit what we will get from this is that we have $102 as the strike price minus $98, which is the market value, minus the premium of $1 which we have paid. So this means that the profit what we generate is $4. This is coming from here minus $1, which is equivalent to $3. So we have a profit of $3 and a loss of $3. So this negates each other and we have $0 as our net position. So you see that at $98, when the market has fallen in our example, we break even. Now let's analyze another position which is at $100. At $100, what happens? The market, if it is somewhere here, at $100, again we see that the market value is less than the strike price of the call option. That is, this is the call option. So the call option will not be utilized. So we will give away the premium, that is $3, and we will have a loss. The from the but the put option will be exercised because we have the markets have fallen below the strike price of the put option, and the strike price is at $102 minus the market value of $100 minus the premium of $1 which is paid. So we have a net profit of $1. This is the net profit. The net position is that we have lost $3, that is minus $3 plus $1 because we have made a profit. So this makes a net loss of minus $2. So at this point, you can see the blue line is cut somewhere here at minus $2. So this is our net position. Let's analyze one last position, that is at $90 market price. So $90 is somewhere, it will be somewhere far away. So let's say this is somewhere here, and the markets have fallen below the strike price of the call option, so the call option will not be utilized. So we will give away $3, which is a loss for us, and the strike price is $102 minus the market value of $90 minus the premium of $1 will generate a profit of $11. So our net position is that minus $3 plus $11 will give a profit of $8. So if you see the graph fully, then you will notice that you will have a profit of somewhere around $8. So you see that again, the markets have to either fall sufficiently or have to rise sufficiently in order for us to make a profit when we use the Straddle's strategy. Now we see the buyer's position when the markets can fall or rise. So the complete picture, what we have discussed in parts, let us see it in a single picture now. So you notice that the maximum loss what the buyer can make is the net premium what he is paying, that is here. However, he will never really suffer this much amount of loss because the markets will move. This premium, he will lose the total premium, net premium, only if the markets do not move at all. That is quite impossible. However, that's a mathematical possibility only. So this will not happen, but the markets have to move either in one of the directions sufficiently so that the profits can be generated. So till the markets do not move sufficiently, the buyer will suffer a loss. That is, he will be in this area. The important thing to note is that the possibility of profits for the buyer is unlimited. He can earn a lot if the markets really swing. It happens during elections when the results announced, markets swing in one direction in a very heavy manner. That is why the straddles option is applied by the investors. But his loss is limited, though the loss is more, but the loss is limited. So with this, we come to the conclusion of our discussion of the straddle strategy. I hope you enjoyed the video as much as I enjoyed recording it. Thank you for listening.